Good morning, everyone. Welcome to this update for the 5th of April for global stocks and commodities. We've had the initial crash. We've had the very strong rebound. May or may not be finished in that rebound yet. I'm not sure. But volatility will start to settle down. It is starting to settle down. The VIX has just dropped below 50 for the first time in about a month. And so we're now entering a period where it becomes a bit easier and easier to read the charts, and therefore becomes a pretty good environment to trade if you've got the game plan set up to do that. So that's the period that we're in. There's still a lot of uncertainty out there, but there's certainly some tremendous opportunities coming out of this volatility. Now, the fundamentals around an individual stock are going to remain somewhat meaningless for a little while. Not totally, but to a degree, because a lot of the market action is being driven by computer algorithms, and they're basically really just firing off various chart patterns. So understanding how to read chart patterns is now becoming a far more important skill than, it's always been important in my view. Just doing fundamentals alone can lead you into trouble. But the skill of reading chart patterns now is more essential than ever. We'll have a look at the normal stock and commodity updates. And last week in Portfolio Analyst, we had a good look at gold and silver. There were quite a few questions around that. And also I covered off on what to buy and what to avoid in general terms. So the S&P ended up falling. It was a pretty volatile week again. Then it was down on Friday night, as we're seeing quite a lot. Markets just don't want to seem to go into the weekend with too much long exposure. So the S&P was down 52 points, or 2% for the week. And the rally so far has failed at the first Fibonacci level or the first main one of 38.2%. We'll see that on the chart in a minute. But I'm not convinced that the rally is necessarily, this first leg up is necessarily finished. This could be just a little backward step in that process. Now, business activity in America and around the world has obviously crashed. The world has just been put on hold, and this huge whipsawing in prices that we're seeing is pretty much the normal for bear markets, because what markets are trying to do is to price in a very uncertain future. And there is so many unknowns, and even more so now than, let's say, in the GFC, because we don't know how long this virus is going to continue for before it's effectively contained. So yeah, there's just a lot of backwards and forwards in the price as the markets try to work out where realistic prices are. We're in an environment where prices running up to resistance are more likely to turn back down again from that resistance, whereas supports are less likely to hold. So it's kind of the opposite to what you see in a bull market, where supports tend to hold, prices bounce off them pretty well, and resistance levels tend to get broken. Well, we're seeing the opposite now. But as I said earlier, the reading does get progressively easier as things settle down. Now, the US dollar has really been all over the place in the last month or so, anywhere from the mid-90s up to about 103. So we're sitting in the middle of that range at the moment. The 10-year yield dropped down again further. It's also been all over the place from about 0.4 up to about 1%. There was a massive spike in jobless claims at the end of the week in the US, as would be expected, far greater than the GFC. And it's set to get a lot worse, one would think. So the data is going to get worse, but you've got to remember that markets are forward-looking animals, and that they are going to start to price in the lows well before the data stops getting worse. Okay, let's look at some charts. So we'll start, first of all, here's the big picture, monthly chart. This is 2009, and you can see the extent of the move to the downside. Now this is a linear scale, so this looks bigger than what we saw in the GFC. But if I put it on a log scale, it would look a little different. So that's the big picture. Here's the daily chart. So here's our Fibonacci scale from the lows on the 23rd of March back to the original highs, and you can see that we bounced almost exactly to this 38.2% level. Now, it wouldn't be totally unusual if this first leg up, sorry, let me just grab that one again, if this first leg up actually looked a little like that. So in other words, a 1, 2, 3 wave process to the upside. So I don't dismiss this. I'm not at all certain that this is the top of the first leg higher. So this just could be a little interim move down. But from here on in, these oscillations will tend to settle down a little bit. And if we just look at the VIX index, you can see here, this is the VIX, here's normality, and then here we are when the VIX started moving up in the middle to late February. And any reading above 40 is a pretty extreme reading. So you can see we've been above 40 since early March, I should say, and we've been above 50 continuously since the 10th of March, and it only just managed to drop back down beneath that 50 level at the end of the week. So this period of elevated volatility is definitely right up there with the GFC. Okay, so going back to the S&P, so just not sure whether this is the top of the first bounce or not. We'll just have to play it as it comes. Now, if we look at the US dollar, you can see it's been incredibly volatile. We hit a low of in the 94s. We hit a high of 103, and we're sitting around about 100 at the moment. So still incredibly volatile. While I'm here, let's look at the Australian dollar. So again, the Australian dollar volatility has certainly reflected what's going on in the US, but you can see we're way below the 200-day moving average, and you would have to think that the possibility of dropping down towards 50 on the Australian US dollar exchange rate is certainly not out of the question. All right, moving on to the Australian market, the Aussie dollar finished just a tick under 60, and it's really impossible to predict this in the short term. I'm not a currency person at the best of times, so I won't even try. But the long-term direction is still very much to the downside. Now, our index rose by 125 points on the week, but one would think there'd be a bit of a turn down on Monday following Wall Street. So that was a gain of 2.5%, and it would appear that the Australian index is probably outperforming the US in the very short term, but that could just be a bit of a timing issue between when the Mondays and the Fridays actions actually play out. So we had more weekend weakness again. There is some wonderful long-term buys. We may not be there just yet, but it's just really a matter of finessing the entry, being clear about your game plan when the volatility is as extreme as this. But I'll have more to say on that at the end. So let me just take a quick look at the ASX 200 just for the record. And if we look at one of the two worst performing sectors, energy, which has been absolutely smashed, obviously, with the oil price, and also the banking sector has been hit very hard. And it's more likely than not that we're going to see further dividend cuts in the Australian banks. Healthcare sector has held up extremely well, so that's been one of the better ones. That's the ASX 200, and this is materials, so this is effectively BHP, Rio, Fortescue, etc. Turning on to precious metals now, gold dropped by $14. It's been also very volatile, but it did finish above 1600, so it was still a pretty useful week. Now, over the last month, gold has been smashed by around about $200, along with stocks from the middle of March. Now, that often happens in a significant correction or crash because they become a liquidity driven event. People that are struggling with excessive leverage and margin calls, and it could be in asset classes completely unrelated, could be in the bond market. And there's just this drive for liquidity, and so everything that's liquid gets sold. And so in the very short term, gold and gold stocks don't necessarily offer you the protection that you would think. That's yet to come. And it may not seem like it, but gold has been really the outperforming asset of the last 12 months. It really has done very well, and the environment is becoming more and more conducive for gold, so it's hard to see that outperformance not continuing. If we look at precious metal stocks, GDX absolutely capitulated more than 40% from mid-March, fell all the way to a close at 19, which was support, and so we got a bounce from there, a pretty spectacular bounce, 42% turnaround on the 16th of March, and such a reversal as that. We'll take a look at that in a minute. Really does mark a very likely reversal low. So it's quite probable that we have seen the lows in GDX. At that point, the greed had been washed out of the market. If you've been watching this video for any length of time, you know I've been talking about the overhang in the gold futures market and how that had to wash out because there was very little new buying could come in from that speculative area, and it's such a highly leveraged undertaking, trading gold in the futures market, that it really did need to get washed out. So that has happened now. The greed has been washed out of the market, and the upside potential here for gold and gold stocks is really quite large. And I would add, for what it's worth, and fundamentals are not worth as much as they normally are right at the moment, but this environment for gold stocks is certainly supported by extremely strong fundamentals. You know, gold stock profits have been soaring and will continue to do so. So it's a terrific environment for this asset class. It's not an easy asset class to trade or invest in, so you know you just don't want to think that this is a one-way trip to the upside, because it's never that easy. But certainly on a medium to longer term view, the sector is very well positioned at the moment. So we'll look first of all, there is gold on a daily chart. So we had the liquidity driven smashing. We then had the incredible rebound, where we rebounded from 1460 to about 1640. We've had a little pullback to the downside. This actually looks really positive from a chart point of view. This pattern here, where you get a sudden sell-off, and then you get an immediate move back to the upside. That looks pretty promising to me. So we may well see gold have another crack at $1,700 in the next few weeks. If we look at this on a weekly chart, you can see the volatility has effectively knocked it out of the trading channel, but that's okay. I can accommodate that. It was only for a week, and yeah, you've just got to say that the trend direction in gold is unquestionably to the upside. Now, silver has definitely been lagging for reasons that I've discussed in Portfolio Analyst as well. So nothing too surprising there, and silver may get into a period of catch-up at some stage. Now let's look at GDX. So you can see the incredible rebound that we had, and this is a weekly chart. So the rebound from around 16, and at one stage we were up around $25 within that particular week. So really quite two extraordinary weeks where the price went from 28 to 16, and then finished at 25 effectively. So amazing volatility, but certainly opportunities are presenting in that space, and certainly for the Australian gold miners as well. Moving on to other commodities, copper edged slightly higher. It was really a bit more about currency moves, I think. But crude oil absolutely surged to 28.3. It had been down around 19. There's been a massive drop in demand. I know that there's something like 3 million barrels a day just for US gasoline requirements off the demand side. So a really big drop there. But what really got crude oil fired up was a possible Saudi-Russia deal. Whether that will come to pass or not remains to be seen. But certainly this sort of volatility in crude oil is not helping. So the Saudis and the Russians need to get together and resolve this. There's the spot copper chart and nickel. Not much movement in those base metals, just hugging those lows. So to wrap it up, and this is partly what I said last week, and I'm going to repeat it because I just think it's so important. You just got to get real clarity around your targets. Are they stocks that have held up really well, like in Australia, the A2 Milks and the Fortescue Metals and stocks of that sort of ilk, and they look like being really strong businesses going forward? Are they large caps in sectors that have got tailwinds? So in sectors associated with with 5G or with some of the amazing new technologies in artificial intelligence and healthcare. Are they those sort of stocks? Or are they smaller quality growth stocks that have very strong balance sheets, virtually no debt? They've been absolutely smashed because they're small caps, but are they virtually certain to get through this period, and are they going to come out the other side even stronger? And there are plenty of these sort of stocks. Again, a lot of them in the technology area. These have all got a potential place in your game plan. Now, right now, the smaller stocks are unlikely to maintain a sustained bounce back because that is another characteristic of these sort of periods. It's going to be the large caps that are going to attract the fund flows initially. But all these opportunities have a potential place, and what you don't want to do in this sort of market environment is just grab at unrelated opportunities as they come onto your radar. You've got to have a game plan about what you want your portfolio to look like in 6 months' time. And then you go out and you find the stocks that fit that game plan. The next thing is you need to be very clear about your process. Now that things are probably going to start to settle down a little bit, they're still going to be volatile, but not as extreme as we saw from the middle of March. Are you going to trade the volatile ranges and the volatile bases? Because they're very tradable. And I'm going to be working on this a lot with my memberships as well. There's opportunities here to buy something on a sell-off, write it up for perhaps a few days or even a few weeks, and then take that profit and move on and look for another opportunity. So it's really a matter of keeping your overall exposure low, just in case, but take advantage of the rebounds. And if you're going to do that, then you need to know what is the signal that's going to get you in. You can't just guess at this. Are you going to take quick profits on what we see is just some amazing percentage rebounds? We're seeing 20, 30, 40% rebounds in a day. How are you going to stay on top of the larger picture? Because there is obviously a much bigger picture at play here, and we need to know where the bigger picture direction is. If you're not a trader, if you don't think of yourself as a trader and you just don't want to do that, then there are going to be long-term tremendous entries open up what do they look like for you? What are the stocks and what do those entries look like? What are the signals? So you just need to get very clear about all this. Portfolio analyst, this week, as in addition to everything else, I'm going to be looking at finding some of the ideal trading opportunities. So these are stocks that are virtually certain to trade at higher prices in the future in coming months because they're just that sort of business. And also there's going to be fairly limited downside from where they are now or where they may be on the next sell-off. So it's just really using volatility to advantage. You don't have to sit out this period. There is money to be made. So that's it for this week. There's my contact details for anyone that's not a member. Portfolio Analyst Trial is obviously still available, and we'll see what the next week brings. Cheers.